I'm Dan Passarelli of Market Taker Mentoring here on the floor of the CME Group. Well, one of the trades we talked about today in our Market Taker Live Advantage Group Coaching class was in Expedia, symbol EXPE. Take a look at a chart of Expedia. Now this stock, which is at roughly $119 a share, has not traded above $120 a share all year. There's a double top, there's super strong resistance at $120 a share, and implied volatility is rather elevated and it's decidedly above historical volatility. Now, I think that over the next few weeks, that $120 a share level is going to hold. I think the stock will not rise above that level. So the best way to capitalize on this opportunity is by selling a credit call spread, specifically the October 120-125 credit call spread for any more than $1. $1 is the lowest price that I would accept for this spread. Now, the reason why I like this trade is because if that level holds, if Expedia does not rise above $120 a share, by October expiration, the trade's a winner. Now, earnings is after October expiration, so that's not a concern. But implied volatility is rather elevated again, like I said. That makes the spread more expensive. That means when I sell it, I'm getting more, arguably more than I should get for selling this spread. So I'm selling something that's overpriced. I'm selling something, a credit spread that doesn't have a very likely chance of getting through the short strike price. So I have a pretty low risk opportunity here, low chance of getting into trouble. Now, speaking of getting into trouble, if it turns out I'm wrong and Expedia rallies above $120 a share, that's rather simple and straightforward. I would just simply close the trade and move on, because I think in a situation like this where we break out of a very strong resistance level, there could end up being some pretty good follow through. So I'm now looking to do an adjustment here. If the trade were to go against me, I would just simply purely be closing the trade and moving on. Now, as far as taking profits, yeah, the most I can make is whatever it is I collect for the spread, but I'm not looking to reach that maximum profit. What I'm looking to do here is I'm looking for something more like to take about 75% of my maximum profit. That way, what I'm doing is I'm taking the lion's share of it, but I'm taking my risk off the table and not holding this all the way until expiration. Once again, this is Dan Passarelli of Market Taker Mentoring here on the floor of the CME Group.